Welcome. What is 401k? How to withdraw funds without penalty? What is tax benefits of 401k investment? In the United States, a 401 plan is the tax-qualified, defined contribution pension account defined in subsection 401 of the Internal Revenue Code. Under the plan, retirement savings contributions are provided by an employer, deducted from the employee's paycheck before taxation, and limited to a maximum pre-tax annual contribution of $19,500. Other employer-provided defined contribution plans include 403 plans for nonprofit institutions, 457 plans for governmental employers, and 401 plans. These plans may provide total annual addition of $57,000 per plan participant, including both employee and employer contributions. Taxation: income taxes on pre-tax contributions and investment earnings in the form of interest and dividends are tax-deferred. The ability to defer income taxes to a period where one's tax rates may be lower is a potential benefit of the 401 plan. The ability to defer income taxes has no benefit when the participant is subject to the same tax rates in retirement as when the original contributions were made or interest and dividends earned. Earnings from investments in a 401 account in the form of capital gains are not subject to capital gains taxes. This ability to avoid this second level of tax is a primary benefit of the 401 plan. Relative to investing outside of 401 plans, more income tax is paid, but less taxes are paid overall with the 401 due to the ability to avoid taxes on capital gains. Withdrawal of funds. Generally, a 401k participant may begin to withdraw money from his or her plan after reaching the age of 59 without penalty. The Internal Revenue Code imposes severe restrictions on withdrawals of tax-deferred or Roth contributions while a person remains in service with the company and is under the age of 59. Any withdrawal that is permitted before the age of 59 is subject to an excise tax equal to 10% of the amount distributed, including withdrawals to pay expenses due to a hardship, except to the extent the distribution does not exceed the amount allowable as a deduction under Internal Revenue Code Section 213 to the employee for amounts paid during the taxable year for medical care. Amounts withdrawn are subject to ordinary income taxes to the participant. The Internal Revenue Code generally defines a hardship as any of the following: unreimbursed medical expenses for the participant's spouse, or the participant's dependent. Purchase of principal residence for the participant. Payment of college tuition and related educational costs such as room and board for the next 12 months for the participant. The participant's spouse or dependents, or children who are no longer dependents. Payments necessary to prevent foreclosure or eviction from the participant's principal residence. Funeral and burial expenses. Repairs to damage of participant's principal residence. Some employers may disallow one, several, or all of the previous hardship causes. To maintain the tax advantage for income deferred into a 401, the law stipulates the restriction that unless an exception applies, money must be kept in the plan or an equivalent tax-deferred plan until the employee reaches 59 years of age. Money that is withdrawn prior to the age of 59 typically incurs a 10% penalty tax unless a further exception applies. This penalty is on top of the ordinary income tax that has to be paid on such a withdrawal. The exceptions to the 10% penalty include the employee's death, the employee's total and permanent disability, separation from service in or after the year the employee reached age 55, substantially equal periodic payments under Section 72(8), Qualified Domestic Relations Order, and for deductible medical expenses. This does not apply to the similar 457 plan. Many plans also allow employees to take loans from their 401 to be repaid with after-tax funds at predefined interest rates. The interest proceeds then become part of the 401 balance. The loan itself is not taxable income nor subject to the 10% penalty as long as it is paid back in accordance with Section 72 of the Internal Revenue Code. This section requires, among other things, that the loan be for a term no longer than 5 years, that a reasonable rate of interest be charged, and that substantially equal payments be made over the life of the loan. Employers, of course, have the option to make their plan's loan provisions more restrictive. When an employee does not make payments in accordance with the plan or IRS regulations, the outstanding loan balance will be declared in default. A defaulted loan, and possibly accrued interest on the loan balance, becomes a taxable distribution to the employee in the year of default with all the same tax penalties and implications of a withdrawal. These loans have been described as tax disadvantaged, on the theory that the 401 contains before-tax dollars, but the loan is repaid with after-tax dollars. While this is precisely correct, the analysis is fundamentally flawed with regard to the loan principal amounts. From your perspective as the borrower, this is identical to a standard loan where you are not taxed when you get the loan, but you have to pay it back with taxed dollars. However, the interest portion of the loan repayments, which are essentially additional contributions to the 401, are made with after-tax funds, but they do not increase the after-tax basis in the 401. Therefore, upon distribution/conversion of those funds, the owner will have to pay taxes on those funds a second time. Rollovers. Rollovers between eligible retirement plans are accomplished in one of two ways: by a distribution to the participant and a subsequent rollover to another plan, or by a direct rollover from plan to plan. Rollovers after a distribution to the participant must generally be accomplished within 60 days of the distribution. If the 60-day limit is not met, the rollover will be disallowed and the distribution will be taxed as ordinary income and the 10% penalty will apply, if applicable. The same rules and restrictions apply to rollovers from plans to IRAs. Thank you for watching this video. Goodbye.